morning, ladies and gentlemen, and welcome to the first live webinar for 2022. We are so fortunate to have so many attendees with us today, and we hope that you will enjoy this slideshow with us. Right, so February was definitely the month of love. And we also noticed how so many people often fall in and out of love with the Rand. Over the last 20 years, it is interesting to see how the Rand is always at the heart of any offshore investing debate. Whenever someone can't really back their reasons for why they wish to invest offshore, the default answer seems to be the Rand. Over the last 10 years, the Rand has really shown its volatility. But when looking at this graph, you can also see that there has been points of absolute resilience. I think with most investing, it's the same that timing can be of such a detrimental effect to a portfolio. And combining that with poor or very expensive valuations offshore, you can really have an irreversible effect on a client's portfolio. So what is the true value of the Rand? A question so often posed. The recent Big Mac index shows that the Rand should be closer to a fair value of R6.86. Now, a Big Mac in South Africa costs roughly 39 Rand and $5 in the US. Now, on a very basic PPP price calculation, this then gets you to the R6.86. Though when we take something such as GDP into consideration, we can see that the undervaluation of the Rand is 55%. The only other currency to be more undervalued than the Rand currently is the Russian ruble. And then the Paraguay currency seems to be the most overvalued. So what we will show you today is that we've decided to launch two global model portfolios, the Global Balanced and the Global Growth. Now, this model was launched last year. And we also have the Amity BCI Global Diversified Feeder Fund. Both these model portfolios are domiciled in USD. They were built using proprietary research. Both of them target US inflation plus. We make use of a building block approach, and both of these models are now available on Glacier and the Allen Gray offshore platform. I'll take a moment just to take you through some of the ideas behind how we built the global model portfolio range. Initially, we started to build a neutral allocation for each of these. So we went back and started with 20 years worth of data. This roughly translated to 239 monthly data points. We eventually created a range or a sequence typical to that of the Monte Carlo, where we used 10,000 random monthly data points. We then built paths of rolling 1 year, 3 year, 5 year, and 7 year random sequencing. This then led to a scorecard. The scorecard, as I mentioned earlier, is proprietary to Amity. The scorecard was built for both the asset allocation section and then also for the manager selection part. We went to test numerous permutations to eventually get to our strategic asset allocation. This also highlights if we then translate it to certain metrics. We consider the best return outcome over a 7-year period, for instance, a downside of 80% of the time above a certain value, what the worst outcome could potentially be, which portfolios can improve on, for instance, the likes of inflation over the medium term, which portfolio mix is the best at a certain of meeting a certain portfolio objective, and then lastly, how fat is the tail of outcomes on the downside. Let's flip this over then to certain metrics, and you can see that we look at expected returns over 7 years for instance, the global growth, 20th percentile at 7 years, the minimum yearly return, the SIVA of 20th percentile, your excess US CPI over a certain benchmark, so excess of CPI plus 2% or 4% over their respective rolling periods, and then also excess US CPI over 3 years and 7 years. Now here I've taken a snapshot of, for instance, the global balanced portfolio. You can clearly see from this allocation that we've made a split between DM equity and EM equity. On the DM equity side, we have, for instance, Fundsmith, 91, and Fidelity. On the EM side, we have Baillie Gifford and also Fidelity's Emerging Market Fund. With DM bonds, we sit with 91 GSF Global Corporate Bond Fund. Then we have our property allocation, as well as an allocation to the flexible income. We've also highlighted here that this is part of the outcomes-based portfolios that we've managed. And here you can see, for instance, the worst 1 year numbers of minus 34.3%. Now, this is very important to highlight, and it's very interesting to see as soon as you move to the global space, how the outcomes then start to change over that rolling 5-year period compared to, for instance, a local holding. This then is also just a snapshot of the recent return numbers. So you will be able to see that this portfolio has done extremely well actually in the recent 1 year number. Also in line with the 3-month USD LIBOR plus 2% benchmark that we use in this, as well as that ICE LIBOR 3-month USD benchmark. On the global growth side, we also show you then the DM equity, Fundsmith 91 Fidelity is again the holdings there. However, now you can see that the global equity allocation has then increased to 70%, with a global property allocation of roughly 9.67%, a bit of global cash, global bonds, and then some local exposure that we obtained through that Coronation Fund. And again, we show you the range of outcomes over that 1 year, and then because this one extends now, it becomes a 7-year return period. This then again highlights the snapshot of that return of that global model portfolio, again priced in USD. And you can see here the 1 year number, 12.9% in USD terms, very competitive again with that strategy or that benchmarks that we set out, the 3-month LIBOR plus 4% in this case, as well as the 3-month LIBOR USD. So what we're really talking about today in terms of the offshore investing, and we have 2 guest speakers who will join us, is that you cannot, like we mentioned now, when considering the Rand as your only or your starting point for investing offshore, there should be some other factors to consider. This being diversification benefits, potentially tax benefits, and both our speakers will take us through some of those benefits and the reasons why we believe offshore investing do make a very important component in financial planning. So let's meet some of the managers that we use within our global model portfolio range. So we've talked about Fundsmith. So here we highlight Fundsmith Equity. Now, this fund is a very well-known fund for South African investors, perhaps more well-known than some of the other names that we will talk through today. This fund is managed by Terry Smith. It's an equity style with a buy and hold, very high quality businesses, highly concentrated sector allocation of roughly 20 to 30 stocks. The turnover of this portfolio is very low and has been for quite some time. They have made some recent changes if you maybe attended Terry's recent quarterly updates, but their holdings are typically a high competitive advantage type of setup. So this is also a term that we will mention with the 91 fund. So you'll see the overlap there in terms of some quality styles, low need for leverage and bias to consumer staples and healthcare. If we take a bit of a snapshot overview of this fund, just to show you the breakdown, for instance, you can see that it's also very much a consumer defensive and some healthcare stocks, very biased towards those stocks. And also concentration is very evident when you look at the top holdings, which makes up 50% of the portfolio. Focused on very large cap defensive stocks, which is not surprising to see then your consumer defensives and your healthcare, as we mentioned here. with largely their exposure to your developed markets. And then that's also then the reasoning of the Fundsmith DM equity holding within both our global model portfolios. Then we have the 91 Global Franchise. Now this fund is obviously very hard to replicate, also again enduring those competitive advantages. Dominant market positions in stable growing industries, low sensitivity to the economic and market cycle, healthy balance sheets, and low capital intensity. Sustainable cash generation and effective capital allocation. So 91 franchise, definitely, as we know it in South Africa, is that quality holding that you will have in your portfolio. And also we see large value in the brands that they hold, intangible assets, concentration evident again in the top holdings, and then 50% of can be seen in 50% of that portfolio. Some of their holdings that we highlight there: Visa, ASML Holdings, you have Moody's, in Microsoft Corporation, Booking Holdings at VeriSign, Nestle, and Philip Morris as well, some of the examples that they hold in their portfolio. Then we move on to Fidelity Funds World Fund. So Fidelity will be featured both in our developed market as well as our EM side. So when we look at the developed market side, the fund manager is a very well established, well-resourced team. The fund only invests in developed markets. And there we see Jeremy Podger join Fidelity in February of 2012 and manages the Fidelity, also managed the Special Situations Fund, the sterling pound version of that fund. And he has been managing global funds since 1990. So they are very benchmark cognizant, and they will typically have 50 to 90 holdings and invest in companies that fit 3 special situations: exceptional value, unique business, or corporate change. So again, we can see regional focus is far more diverse. The holdings are spread across the portfolio. So it's very much or very less concentrated than the likes of, for instance, our 2 funds, 91 and Fundsmith. The top sectors more representative of your less defensive style holding, technology and financial services. It's very important to also now make mention of the fact that in both of the model portfolios that we hold, that we do not make any regional calls, and we really leave that up to the fund managers as well. And I think it's quite evident when you then look at the holdings within Fidelity, within 91, and within Fundsmith, how well they are then blended in order to obtain that type of exposure for us. Then we look at the Fidelity Emerging Markets Fund. So there we see Nick Price. He has run the strategy since July of 2009 and has 15 years of emerging market experience. Now, a team of 48 emerging market research analysts located across the globe feed ideas to the regional managers, and then obviously Nick himself. And his team primarily looks for firms with strong and sustainable returns capable of operating without external financing. And this fund will hold typically 50 to 70 stocks at a time. And again, as I mentioned now, the fact that Amity as a team won't make those regional calls, we leave it up to a team such as Fidelity with your roughly 48 team members researching your emerging markets. Here you'll notice that snapshot once again of what Fidelity then holds, high level of technology stocks that you can also see there. And then unlike the DM fund managed by the same Mango, this EM fund is then a lot more concentrated with a large exposure then to your Asia emerging markets. Then we have Baillie Gifford, also perhaps not as well known to the South African market yet. So Baillie Gifford, make use of the Worldwide Emerging Market Leading Companies Fund, highly active long-term investors with a very much earnings growth focus, 35 to 60 stocks, large cap within that EM universe, owner managed and independent, no external stakeholders driving the short-term gains here. And the team turnover at the firm is less than 4%. Here's a snapshot then of the Bailey Gifford Fund. So high level of alpha generation, similar sector allocation to some of our DM managers, talking to the fact that these EM companies are so competitive. Large focus again on Asia, and then more cyclical in nature than other funds held. We then also make an explicit allocation to property, in this instance, global real estate. So we make use of the Catalyst Fund. So they have 20 years of real estate experience, 12 investment professionals on the team, and more than 50% of the fund is allocated to non-traditional subsectors. So this includes very interesting stocks such as lab space, data storage centers, smart warehousing, single family residential homes. So that's their focus on quality of management, capital structure of the REIT. And then lastly, when we look at our DM fixed income portions that we use Coronation Global Strategic Income Fund. So they, for cash proxy, low duration, we have the 91 GSF investment grade corporate bond funds, which successfully adds alpha to benchmark and can be accessed only via Amity. So that's our, so that's a bit of, I suppose, a bit of an added benefit then using the global model portfolios that Amity offers, is that you can access that fund through Amity. And then also just in terms of perhaps a bit of a cost advantage and for diversification benefits, we make use of iShares. So that is the only passive or tracker fund within the global model range, the iShares Global Government Bond Index Fund. So that is our global model portfolio range. As I mentioned, they are all domiciled in USD and available on the Glacier platform as well as Alan Gray's offshore platform. And then the one fund that has a bit of an older track record now, which is the Amity BCI Global Diversified Fund of Funds. So this fund is not a model portfolio, it's a normal CIS unit trust fund. It is a feeder fund, so not directly domiciled then in USD. So this is also part of our offshore offering. So there you can see we hold 45% in foreign equity, roughly 40% foreign cash, 13% foreign property. The fund managers here, again, you'll see the names of or the likes of Fund Smith and 91 and Catalyst again. One manager here that also might be a bit newer for the South African market would be Sands Capital, that we've included and incorporated as one of the funds that we hold within this portfolio. So the Global Diversified Fund can be used as a standalone fund. We also use this as the global component within some of our outcomes-based model portfolio ranges. So excellent one-year number. We can also see a very good 5-year number and very competitive since inception of this fund. The target here is the CPI plus 6% target range, and you can see it was very competitive over those various periods. Also maybe highlighting now that the Global Diversified Fund, as we mentioned, is a CIS, not a model, and RAND denominated. So some of the considerations is that there's a much more broader investment universe when you consider some of the holdings and the underlyings in this fund. The RAND effects then included in capital gains calculation. It's easier to access for your smaller clients. And then something in terms of the effects, remember that we hold a fund such as Sands Capital Growth Fund. Also, another effect to just consider that if the RAND depreciates, it may appear to outperform the offshore model portfolios. So when you do have that like-for-like comparison, but also no implication from trades within the CIS solution. So that is, of course, a benefit in terms of the CIS fund. So that then, ladies and gentlemen, is just to provide you with some feedback in terms of the offshore offering that Amity can assist you with. But today's session and the whole theme of this month for Amity is investing offshore with Amity. We do have today Wynand Venter that will join us from Glacier. I will now hand over to Wynand, who will just talk through, he's from Glacier, and he will talk through some of the advantages of, for instance, the platform, how to use that, what to consider in terms of the structures at that they offer from Glacier International. So he's a business development manager at Glacier International in Pretoria. He joined Glacier in July 2019. And prior to joining the platform, he worked at Encompass Forex, specializing in offshore transfers, primarily for clients looking at offshore investments via the platforms like Glacier International. So thank you, Wynand, for joining us today. I will just see if I can, here we go.
Hi, Tanya. Thank you very much. I do appreciate the opportunity that you presented to us in speaking with you and as well as to your clients today. We are very much looking forward to working a little bit closer to you in the future as well. If I can maybe just share my screen here for a second. Here we are. Is that fine, Tanya?
Yes, thank you so much.
Fantastic. Thank you very much. Thank you, everybody, for your time. I'm going to try and keep it as sweet and short as possible. You're more than welcome to also let Tanya know if there's any questions, but I'd like to start off with taking a moment to understand why structuring is important to take into consideration when making offshore investments. Clients, for example, going alone without the use of any structures, like, for example, the wrapper product, do open themselves up to some tax complications or implications, as well as complications when the offshore estate that's been built up needs to be, wounded up. Calculations of actual hard currency gains, filing of returns according to your own effective tax rates, all has an important consideration that you need to take note of when making these offshore investments in the first place. We do know that there's multiple offshore platforms that you can actually use for different sets of products. So it is also possible that you are going to have to use different centers to evaluate your entire portfolio, which could become quite cumbersome. Compared to using the benefits of a wrapper product like the Global Life Plan in the first place, where tax is efficiently handled and administered within the structure itself on behalf of our clients. It also takes care of complications that it's not necessary for any offshore estate to be wound up or any executive fees to be applicable, etc. I'll touch on those benefits in just a moment. And then the platform also offers flexibility in terms of all different types of investments that can be held within one product that's got one platform login for you to efficiently monitor your entire portfolio. Taking a moment to look at the necessary probate risk and what that potentially means for clients in the first place is that it could have complications for an offshore estate that needs to be appraised. The value of the assets, for example, to make sure that there's no debts or taxes outstanding. The process also includes whereby a will is accepted by a court as a legal document, yes or no, and with that I mean a local last will and testament. These procedures are very strictly handled offshore, and most countries doesn't even recognize the South African last will and testament, which in effect can mean that you need to draw up an offshore will, which by default also means that it may be necessary for an offshore executor that needs to be appointed, in addition to the local one, which has additional complications with regards to admin and the time it takes to actually wind up both the local as well as offshore estate. And the process also incurs additional costs that clients needs to be mindful of. In addition to the probate risk, it is also possible for clients who built up an offshore investment asset that it could be, for example, be classified as a CITES asset. I'm using the US as a jurisdiction as an example here, which CITES assets could potentially have the US inheritance tax applicable, or that needs to be redeemed from the investment for clients directly invested offshore. Here you can see, as an example, once again, that the tax rate starts at, for example, in the US at 18%, depending on the AUM of the client's portfolio, of course, but it could potentially be as high as 40%. The UK, for example, is another great one to actually use, who's got a 40% direct one-off inheritance tax that will be applied if a client's portfolio is in excess of £325,000. So with that being said, just as a confirmation of what we as Lacy International has available as a product set, is we've got two different life wrappers. For example, the Global Life Plan, which is the endowment. Our Global Investment Plan is our sinking fund, primarily being used for entities like a trust or a company that's looking to invest offshore via an asset swap facility. And towards the end of last year, we also launched our LISP or discretionary savings plan product, the Offshore Investment Plan, which are also available for clients to actually use. Among the benefits of using the wrapper in the first place is, for example, financial planning benefits relating to estate planning, that the fact that there won't be any probate risk, tax efficiency is handled, like I earlier mentioned, within the structure itself, and the endowment will also have insolvency protection. But taking a look into the individual benefits of the wrapper, with estate planning benefits, I do refer to the option clients have in having multiple owners for the same investment within the Global Life Plan structure. It can also accommodate additionally beneficiaries to be nominated within the Global Life Plan itself, whether that be beneficiaries for ownership or beneficiaries for proceeds. That also takes care of the offshore estate problem, or even the last will and testament that doesn't need to be drawn up, or even for the local last will and testament that doesn't need to be amended accordingly, since the planning of the estate has been provided within the structure itself. That also means that there's no executive fees applicable for the offshore asset that the client has actually accrued, as well as no risk with the asset being declared as Citus asset. The tax efficiency that I alluded to earlier means that all and any calculation of taxes and the administration thereof is handled within the Global Life Plan on our client's behalf. Effectively, that means that there's no responsibility in the hands of the end client themselves to declare any tax-related gains of the offshore investment. CGT on the platform is calculated at 12%, income at 30%, dividends at 20%. And this is important to note that it is taxed or administered on hard currency gains. Rand appreciation is no interest in that calculation, so you do have the protection against the rand appreciation built into this directly offshore investments. The Long-Term Insurance Act also applies to insurance policies, including the offshore endowment, which is our Global Life Plan, which means that after a period of 3 years, the offshore asset for the client will be fully protected against creditors for as long as the client is also invested within the structure itself. So that being said, it is short and sweet, but also another benefit of using the platform as well is the consolidated reporting aspect of using a platform in the first place to house multiple investment options or instruments in the same vehicle with an easy access point, so you can amend or review your entire portfolio, whether that be in unit trusts, share portfolios, or like the model portfolios that Amity recently launched directly on our platform, which gives you the benefits of the instrument or the DFM, which is Amity in this case, also in addition to the benefits of what the platform actually can provide to a client. End clients as well as brokers will actually be granted access to our website, which is live 24/7. But if there are any questions relating to offshore investment or to Lacy International as a company, I will be your direct point of contact for any questions or answers. Thank you very much. That's basically in a nutshell what we can provide to your clients as well. And like I said earlier, if there's any questions, more than welcome to let Tanya know as well. Thank you.
Thank you so much, Wynand. I think that sums it up quite nicely, and it's definitely such an effective platform to use and an effective investment vehicle that any advisor should definitely consider for their clients. I know it's end of tax season, so some of the advisors that might still, be considering taking out money right now, not necessarily, waiting for the new tax season or whatever. So it's definitely a product that they can consider, and they chat to you directly, like you also mentioned, if there are any questions, if they don't yet have a Glacier International BDM. So thank you, Vainan, for pitching that and positioning the Glacier Life platform.
Thank you very much, Anna.
So also part of today's session then is not just then on the platform and the advantages in terms of the tax structures that the platform offers, but we also wanted to get a bit of a view and a feeling from one of our other asset managers, 91, to see what their feeling is with regards to this whole macroeconomic situation, especially on the global side. So I think one such question is, will the Ukraine and Russia war really, continue, or is this just the media enjoying the headlines? So that's perhaps one of those questions that some of the advisors might have. I started the session today saying that where the rand is according to the Big Mac index. So Louis, I'm really, saving you from anyone asking where the rand is going to be at, because I don't think that's something we should even consider asking at this stage. So, but Louis is joining us from 91. He's one of the investment directors. As a member of the investment team, his primary role is to provide investment related support to the firm's clients and institutional and advisor distribution channels, acting as a proxy for portfolio managers, and Louis is responsible for communicating the investment philosophy, process, and performance of a range of the 91 South African managed strategies. Before joining the firm in 2005, Louis worked at Investment Solutions from early 2003, and in 2000 he joined Sage Life as an investment marketer. So Louis, thank you so much for joining us. I'm assuming you're joining from Cape Town today. I hope the weather is well there. So, but Louis, over to you, and thank you for joining us.
Excellent. Thanks, Tanya. I don't know if anybody can hear me. All good?
Yes.
Excellent. Yes. The only reason why I quickly put up my picture is just to show off my new tie, because it is actually quite funky. But just to make sure that all the video feed is actually good, I'm going to stop sharing my video so that we can also go. Excellent. Then just quickly from my side, as we go along in the international markets, where you actually want to see what are some of the key developments and key trends that we're actually following, I just want to make sure, there we go. What these graphs just show is just over the last 2 and a bit years, that shows the development and what markets have actually done. And I think this is on the international markets in dollar on the left-hand side, and then on the right-hand side, you get the domestic market. And you can actually see that the shape of the development over the markets are actually fairly similar. And the main reason is the big sell-off was driven by global factors, and therefore have an impact on all markets across the world, in South Africa market, as well as what has been happening internationally. And then also the recovery was quite quick. And it's been probably one of the fastest recovery after a global sell-off. We've seen markets losing about a third of their value in the space of a 2-3 month period in the first quarter of 2020. But since then, the 22nd of March, markets have actually recovered extremely quick, with the MSCI ACWI index recovering all their losses in dollars within the 4-5 month period. Our own market took a bit longer. We took about 7-8 months to recover all the losses. But then what is also interesting is that initial phase of the recovery was all to do about the stay-at-home sectors, technology sectors, even commodity sectors to a certain degree, that have actually boosted market returns. But very importantly, on the day, it's almost a week after Biden came into power, the announcement of vaccines were released, and that gave value assets and a broader sense of market and different sectors, gave it a boost, and we saw a second leg up for equity markets across the world and even in South Africa, and that was since the announcement. However, what is very interesting is just look at this last bit of a while, very interesting that we saw basically since the middle of December, but especially since the beginning of the year, it looks like global markets are running out of steam. They've actually seen quite sharp drawdowns. But what is quite funny is normally when international markets come under pressure, your South African equity market fall by even more. But what we're seeing over a year-to-date basis, now it's only been 6 weeks, so it's extremely short, but SA markets are actually doing much better and holding up much better than international markets. And this is twofold. One, SA markets are being held up mainly by the recovery of commodity shares. And then secondly, the Rand, in this period of global uncertainty, the Rand is actually holding up very strongly. And normally the Rand would weaken. And we've actually seen the Rand strengthening in a bit. And it's one of those weird things, you can't explain it, because if somebody were to say, Louis, there's increase in heightened risk, the first thing that I've said, the Rand would blow. And it is not happening. What we just expect, and there's a lot of excuses and things that you can talk, and you can say, oh, South Africa offers a much bigger yield spread, and all those things that you can actually say. What we just believe is that the biggest sell-off currently happening globally is in the hot sectors, those smaller cap technology sectors, things like Bitcoin, all those type of markets were the big beneficiaries, especially over the last year, of this high levels of liquidity that has been coming into markets. And funny enough, South Africa never received any of that hot money. So now with a bit of uncertainty that's creeping back in, that hot money is the first money to be pulled from markets, and it especially is being pulled from the smaller cap technology sectors in the US and even in things like Bitcoin, compared to South Africa, which never received any of that hot money, and that's why our market is actually holding up a bit. But the main thing that I think, especially when you speak to your clients, that you've got to remember on this, is the worst thing that you can ever do on an investment is that if you have these periods of significant drawdowns in equities or in markets, like we saw after you've lost a third of your money, the worst thing that you can do is to then make an emotional decision and to go and to sit in cash, for instance, trying to protect the value of your investment falling further. That's the worst thing that you can do, is to go into cash after this. And just quickly put it in perspective. Think about it. If you've lost 34% of your money and you then go into cash, and let's say you earn an interest globally of 1%, it will take you roughly 30 years in earning 1% of interest to just get your capital back. That's 30 years. Compared to if you've just stayed in markets, you got it back in 4 to 5 months. So be extremely cautious not to react emotionally when it comes to investments. I don't think people realize how important that is. And that's, I think, the main reason why financial advisors that give sound advice to protect people from making emotional decisions is so important, a role that they play. Year ahead, and I think this is the summary slide. Basically, what is on the minds of investors across the world at this point in time? The biggest thing, forget about all the other noise that is happening on the side. The main important thing that is happening is we are seeing a change in the monetary or interest rate cycle across the world, where we've experienced a number of years of interest rates just structurally coming down because inflation was under control, and central bankers were pushing economic growth because that was a bigger concern than inflation. That whole scenario across the world, and even to a certain degree in South Africa, that has changed. And with inflation being much higher, it means that interest rates across the world are going up. And that have a total fundamental impact on how markets behave and how they react. And the very simple thing for it is it affects not just bond markets, which typically comes under pressure when short-term rates starts to go up, but your primary input to any equity valuation that you do is interest rates. What is that discount rate that you pay to determine what is a fair value for any assets? And as soon as that discount rate goes up, your fair valuation for companies come down, i.e. its negative impact on the valuations, what is determined as a fair value. And it boils down to very simple. For you to grow your business, you've got to go and borrow money. If interest rates are low, you can actually borrow more money, or your interest, your hurdle rate to open a new factory and pay off the loan to open that new factory, that hurdle rate, the interest that you pay on that loan is much lower. But if interest rates go up, that hurdle rate tends to be higher, and therefore your cost of capital actually increases, and therefore your valuation becomes more onerous when you look at shares. It's as simple as that. And we have to keep that in mind, that this environment has changed, and it will be changing over the next year or 2 and 3 compared to what we saw a number of years ago. Some of the shorter term news that we actually see is currently all about Russia. Now, these Russian potential invading the Ukraine, these geopolitical tensions are extremely difficult to analyze and to act upon. And the reason for that is, first of all, the outcome of these events are normally binary. It's a flip of a coin. 50% they invade and it had this impact. 50% they don't invade and then it's exactly the opposite side. So there's no in between almost. It's a one or the other situation. And then secondly, we can all have all these big plans and analysis, and we sit and there's economists and there's political analysts you call in for their expert opinion and all those things. That's all bollocks, to tell you guys the truth. And the reason for that is not a single one of us, even the biggest political analysts that you get in and all great minds debating it, not a single one of our buggers are sitting in the negotiation room and around the table when Putin and Biden and the political leaders have these discussions. Not a single one of us have got dinner and every night a chat with Putin to find out exactly what is his plans. So unless you have that inside track, you got no more information really as anybody else that see it, what is happening on the news. Currently, what are the big impact that you actually got to understand when you make your decisions around these political events? Understand what the potential outcome is in both scenarios, and then you can either try to mitigate the risks, or what you can do is you can say, listen, I have a strong conviction of something happening, and therefore I'm happy to take the risk. But remember, then tilt your portfolio. You should never, on these political events, because you don't know the outcome, you should never go all or nothing approach. Now, just quickly on Russia and invading, if they do invade, what are the asset classes that will benefit from that? We can actually make a bit of money, because we all know equity markets and volatility will happen. But where can you actually make a bit of money if they do invade? And I sound facetious. I hate wars and the political and the human life that are at risk here. But think about markets, just where can you actually make a bit of money? And the main things that you can actually make if there is a war. Oil will go up, so that could benefit. The second thing is so higher oil price is very bad for South Africa, but also for the global environment. The second thing where you can actually make a bit of money is increase sanctions. Okay, just quickly on oil, Russia produces roughly 10% of the world's oil and natural gas. So if there's sanctions on them because of the war, it means that your oil prices will go up, because they will a supplier of oil will be curtailed. The second thing, Russia is a big producer of the world's palladium. So immediately, if there's concerns about risk on this war, palladium prices and therefore also platinum prices and rhodium prices are actually going up. And interesting, where oil is bad for South Africa, a higher oil price, a higher palladium and platinum and rhodium price for South Africa is actually a good thing. And then the third thing, always when there's increased uncertainty, safe haven assets, i.e. gold, tend to do better. And those are the three beneficiaries. But since last night, when the talk is, hey, Russia is starting to withdraw their troops from the borders, especially on the Belarus side of the Ukraine, on the northern borders, what we've actually seen is that all three of those aspects have actually started to reverse. Oil price is slightly lower. We've already seen about $15 to $20 being pulled from the palladium price. And then also gold prices are slightly softer. But on the flip side, equity assets are starting to recover quite nicely. So it's extremely difficult. What the outcome would be, it looks like currently it's leaning towards no war and a peaceful solution to the increased risk. The second big thing, additional thing that we got to realize, and this relates to this higher inflation and interest rate environment. And I've quickly touched on it previously, but the assets that are most at risk on a rising interest rate environment are those businesses that do not have any long-term profits. It's normally businesses that are still making losses. So these are typical your growth companies. Smaller or mid-sized tech companies is a very good example. And why do you say that? It's because if you've got an established business with long-term earnings prospects, you can value those businesses very easily by looking at a PE ratio because you've got price versus earnings. But a company that is growing, an initial growth company, normally they make no profits yet because they're investing all their money. So if they make no earnings, you can't draw a PE graph on the company because there's no E, there's no earnings yet. So how do you determine what is a fair value? You have to use your discounted cash flow methodologies, your DCF models. And as soon as you do a DCF modeling, what is one of the biggest drivers of this fair value that you calculate? It's your discount rate. And if you use a higher discount rate, that fair valuation on this business comes down. And that's why these growth companies get hit the hardest when short-term interest rate and interest rate expectations go up. And the third thing that is a bit of a concern, and we especially, that was, I think, more last year's concern, has been Chinese growth that was no longer at 8%. It twiddled down to 6%, and expectations is that it could twiddle down further to about 4%. However, where I say that was more a last year's story and therefore negatively impact the Chinese stock market returns, with China actually being one of the worst markets in terms of returns over the last year, especially compared to the likes of the US. Going forward, China could very easily move from being a headwind to a tailwind, because this is the one country where the government is actually going the opposite side, where they say, we don't have major concerns around inflation, and our economy is actually already starting to slow down. There's no overheating in our economy. So we actually in a position that we can start cutting interest rates and be more supportive of the growth cycle. And you've already seen some initial steps in trying to revitalize economic growth in China. So China is actually moving in the opposite side of the interest rate cycle when compared to the US. And as they be more supportive in terms of their monetary policy over the coming year or two, you can actually find that Chinese growth could revive a bit compared to a potential softer economic environment for a lot of the other developed market countries. So hopefully that growth environment should be supportive for Chinese equities, and you'll actually find that the outlook for Chinese equities go from being a headwind over the last year to the growth outlook being more of a tailwind or supportive of the next year. Then just closer to home in South Africa, all the eyes this year will be focused on what is happening with the ANC conference at the end of the year. That is the main political aspect that needs to be considered. And there's a growing tug of war within the ANC. But funny enough, you can say on the side, that's all to do with the ANC, bugger this. But as you know, and we've seen it every year over the last 20 years, the country's president is not chosen at elections, it's chosen at the ANC conference on a 5-year basis, because whoever becomes the leader of the ANC then automatically gets pushed through and becomes the leader of the country. So all eyes and uncertainty will actually pick up. There's uncertainty with regard to South Africa and the stability of South Africa over the year as these developments unfold. Just quickly on inflation, on the US inflation, and I'm running out of time and I know we're short, but I just want, this is so important because we've now seen the US inflation jumping up to 7.5% over the 12-month period. On the one side, the bad side of US inflation, this pickup in inflation is coming from all areas of the world, all areas within the inflation basket. It's goods, it's services, even food inflation is starting to pick up, and energy is a big contribution. So it's coming across the world, it's across the different market sectors. It's not just limited to one specific thing. But the interesting thing is we know inflation is now peaked, or hopefully it's peaked. The last reading in the US was 7.5% after the 7% in December. So the January 1-year number was about 7.5. We think there's another leg up for the February numbers. So we're probably looking at about 7.8% for February's number. But from then onwards, just because of the base effects for things like oil, that now will start, because remember a year ago, oil prices were down at 30 or 50 or 60, it's now at 90. So you got this 100, 200% jump in the oil price that's now in this inflation number, which is a year-on-year number. But as you now start getting a rise in the interest rate, a rise in the US or in this oil price base, it starts resulting in inflation coming down. So that means, based on consensus earnings, inflation in the US by the end of this year should be about 3.3%. But, and this is the big debate, there's a bunch of extremely clever economists that will tell you inflation is going to moderate and should not be a major concern in 12 months' time, i.e. sitting at about 3 to 3.5% by the end of this year. Then there's also a bunch of extremely intelligent economists that will actually say, guys, there's a lot of second round effects that's still coming through on inflation, and inflation will continue to be sticky, especially as long as you still have these bottlenecks because of COVID. And that means that inflation might come down, but we'll probably see a 4 or 5% handle on it by the end of the year, not 3.3%. And that means interest rates in the US will have to go up quicker and faster. And that's a major concern that we all have to face. Oil, this is the biggest risk to global growth outlook and the inflation outlook and the direction of interest rates. Not just because of the potential Ukraine war, because of the lack of supply and inventories that we currently have in the oil market, and the lack of money that's being spent to increase capex or increase the capacity and the supply of oil. So that could mean that oil prices stay fairly stubbornly high. Just also be careful not to be too optimistic and saying it's going to $150 and oil is the biggest buy. The higher the oil price is, the more profitable it will become for other companies to enter the market and start producing. And you've already started seeing some of the US operators in the shale gas area saying, listen, at $90 or $100, I can actually make a lot of money. Maybe I should reopen my production facilities. And that reopening of production facilities could actually result in the marginal increase of supply, which could depress oil. But I always see as oil, I see oil prices as the world's or nature's interest rate. When things are extremely strong and everything is boosting and going strong, oil tends to rise, but because everybody needs it, it actually then have got a negative growth impact over time because people spend more money on oil and on petrol than they can on other goods. So a too strong overheating economy leads to higher oil prices, which then help to cool off that overheating economy. So oil is almost nature's interest rate that we got to keep in mind. Then the last thing that before we just quickly look at some of the valuations, I think be very careful not to run for the hills just because interest rates are starting to go up. And what we've shown here is what did the MSCI ACWI, the World Global Equities, do in the 12 months leading up to the first interest rate hike? And then what did global equities do in the 24 months post the first interest rate hike over the last 4 hiking interest rate cycles that we saw? And what we can actually see, and the black line is the average of all these last 4. And what we see normally when you get the first interest rate hike, in that few months after the first interest rate hike, the first good 2-3 months, equity markets on average have lost about 8 to 10%, and in 2015 have actually lost about 13-14%. So far since the beginning of the year, global equities have lost about 8% since it peaked. So so far, yes, we haven't seen the first interest rate hike yet. It's only going to come in March, but it's going to come. It's being priced in already. We are seeing that initial 2-3 months of volatility. But what we've seen during all previous hiking cycles, after that initial sell-off, equities tend to recover, and they recover quite nicely. And for the majority of periods, over the next 2 years, you can actually still have very good returns from equities. And the reason for that is interest rates and rising interest rate take time, A, before it starts filtering through into the economies and therefore slow down growth. And B, interest rates come off such an extreme low position, level, that you've got to have multiple interest rate hikes before it will start having a serious impact on economic growth. So as long as economic growth remains fairly robust over the next year or two, we see no reason why equities can't continue to give you very decent growth after this initial sell-off and uncertainty around the initial interest rate hike. Unless you have a situation like 1999. And there you can see the recovery was very strong after the first 10 months after the first interest rate hike, but then it started filtering through on a negative trend. And there's 2 reasons for that. One, big areas of the market at that stage were highly overvalued because we had the tech bubble. And the second thing that investors got to realize is growth started to come in weaker. So for me, the things that you need to look out overall, we're more optimistic that growth should be okay over the next 12 to 24 months. And therefore, while there's initial volatility, the longer term outlook for, especially for the next 12 to 24 months for equities remains strong. But we constantly look for 2 things. One, valuation risk. And there, I think investors got to be very selective as to which equities they hold. You can't just go back and say, blacks, and just give me the market, because the market on itself is quite expensive. And then secondly, what is your growth outlook? I'm going to quickly just touch on valuations, because I think that is important. If you look at our global MSCI World Index at this point in time, it is on the expensive side. And anybody that tells you that global equities are cheap are probably trying to sell you an equity fund. So be very careful in terms of valuations, but global equities are expensive because it's driven by a few very large mega cap technology shares with the valuations are fairly high. If you strip out those shares, the rest of markets and other regions outside of the US actually looks fairly reasonably priced. So it's not that the whole market and everything is extremely expensive as the one thing, but to justify equity investments at this point in time, I think you got to be more selective, go and pick the stocks that you think have got the ability to sustain decent earnings growth as things become a bit more dicier, as interest rates continue to rise. And then secondly, be more selective in terms even of your regional exposure. They're sitting back that large cap US stocks will continue to just drive and you can just buy the index. It's probably behind us for the coming years or 2 years. For us, global franchise, most of you can, and you know the fund. For us, what is quite important is our franchise fund do not buy the cheapest stocks. We're not a value fund. We actually chase quality, consistent earnings growth. That quality companies that can provide consistent earnings growth. That's for us much more important than going to buy the cheap value stocks. But what we find, if you look at the current fund from a valuation perspective, even though we don't go and buy the cheapest stocks, valuations like free cash flow yield, your enterprise value to your earnings before interest and tax, all those valuation techniques, we're roughly in line with valuations of the market. So you buy the same valuations than the broader market. But what is quite important is growth, the return on invested capital, the growth component of your fund is significantly higher in the fund compared to what the market is. So you pay the same value, but you get significantly higher growth and consistency in earnings growth. And then also the quality of the business, our business or the fund actually has got a negative debt. If you add up all the weighted contribution or debt of all the holdings in the fund. So to tell the truth, if interest rates go up, the vast majority of our stocks that we hold wouldn't care because it's actually a net negative debt position versus to the relative to the revenue generated for the business. Don't have to worry about rising interest rates for the companies that we own because they do not have significant debt, and that's for us important. Stocks that we own, you all know these stocks, so I don't even need to worry about it, to talk to you about it, but I'd always joke with it. But a company like Microsoft would tell you, and I saw it once, what's his guy's name is Steve Jobs from Apple. Before he died, somebody asked him once and said, listen, Steve, who do you think, and this is now a number of years ago, who do you think will be the next Microsoft? And what Steve Jobs actually said, he believes the next Microsoft will be Microsoft. And the reason for that is the company has got such high barriers to entry in its market, and it's got such a dominant position that is the company that will continue to drive consistent long-term earnings growth. And for us, that's the type of business that we're happy to put our clients' money in there and let them worry with their other client allocations on, oh, is Russia going to impact, or do you go and chase oil prices, or should you go into cash, or should you let clients worry with their other money on all those things. And we just provide a solid building block to provide you with consistent growth and stable growth, especially as volatility continues. Good. That's it from my side. I don't know if there's any questions.
Louis, thank you so much. No, I think the typical questions we often get, you covered most of them. I think one of the things we've noticed from Quality, and Clyde mentioned this on a recent interview, is that if the tapering continues that we see, especially now with the ECB also announcing, like they might hold back on that bond program, that is actually also very good for the quality style and the quality type of stocks. So that's perhaps one of those added benefits. But thank you for touching on valuations. Amity, investment solutions also, we do a top-down approach. We consider the macro environment, which you've touched on today now. We consider valuations, and it talks so well into our process as well. So, funds such as franchise then obviously fits in very well in our global model portfolios. So thank you so much, Louis, for presenting today. I do see a question popped up here. Let me quickly see. No, it does not seem like it was a question. Maybe someone did want to ask something. But if there's anything you guys would like me to pass on to Louis or to Udre from 91, you are welcome to forward those emails or those questions to myself. And then, yes, we will share this presentation with everyone post the session as well. Thank you so much again for joining us today.
Sorry, Tanya, I do see that the comment has come through. It wasn't a question, it's more a comment that the guy said my tie is beautiful. So thank you for that.
Okay, great. Thank you so much, Louis. Ladies and gentlemen, we are very excited to journey with you all on your offshore investing path. You can get in touch with us via email, via WhatsApp, via LinkedIn, or just a good old telephone call. We will gladly assist with any proposals. And should you have any more questions or queries with regards to any of the solutions, and not just on the offshore portfolios, you are very welcome to forward those to us as well. So yes, we wish you all very well and good luck with the end of the tax season. We hope the offices aren't too swamped. And if it is, then it's just good for business. So keep well, keep safe, and we're looking forward to our live sessions that will be next month. So please keep an eye out for the invites that will go out soon. Thank you. Goodbye.